Have you ever seen the movie The Big Short? If you're me, you've seen it several times, but this is a fantastic depiction about the events leading up to 2008. And of course, I think a fantastic opportunity to geek out over real estate and some wine and popcorn or whatever it is that's your jam. Now at the time, credit default swaps. Now, credit default swap is a financial agreement in which the seller of that credit default swap is insuring the buyer against some sort of default. So basically, the seller is saying, hey, buyer, if you go ahead and purchase this, I'm insuring you against some sort of asset defaulting. And at the time, credit default swaps insured mortgage-backed securities. And so hedge fund managers created a huge demand for these supposed risk-free securities, which created demand for the mortgages that backed them. So what happened? Banks and lenders started lending to just about anybody. And so loads of unqualified buyers poured into the marketplace, which created a demand for homes. And then, of course, home prices increased. Now you might ask, were there some warning signs along the way? Of course, the answer is yes. In fact, in the fall of 2005, new home permits had decreased 28% since that spring. And in 2006, home prices had fallen for the first time in 11 years, and we were at a 7.5 month supply of inventory. But the Fed ignored these warning signs because the economy was still doing well at the time, and everybody thought, you know what, hey, we really think the economy can pull through this. But everybody underestimated the size and impact of these mortgage-backed securities. And as things started to get a little bit hairy, some computer programs were written to try to figure out what exactly was going on. You see, these mortgages were separated into these different bundles. They were sold on the secondary market and investors purchased them, but there were a few different things going on. One, these were filled with interest-only loans. So when it was time for the loans to reset, what was going to happen? If prices fell at the same time, people wouldn't be able to afford their payment, but they also wouldn't be able to sell either, so they couldn't recoup their money. So they would be forced to default. And these little bundles and packages were also filled with subprime mortgages. And you'll often hear during that time period, it's referred to as a subprime mortgage crisis. Now, a subprime mortgage is different than a conventional mortgage. This is when a lender or a bank has given a loan to a borrower who has a low credit score and maybe a lot less collateral. And so they're basically a high-risk borrower. So they're at a higher risk of default. Now, at the time, when things were going really well, banks didn't really care who they lent to because one, they sold these on the secondary market, and two, investors were purchasing these bundles, so when times were good, everybody was purchasing the high-risk bundles, which were more likely to default, but they purchased them because they paid more. But as the economy started to head south, the value, everybody knew that these bundles were losing value, but no one actually understood the bundles. And so that created, of course, some skepticism. And at the same time, many of these purchasers of these mortgage-backed securities weren't just banks, but they were individual investors and pension funds and hedge funds. And at the time, the Securities and Exchange Commission didn't regulate hedge funds. So nobody really knew what the heck was going on. And so this spread risk and skepticism throughout the economy. Pretty soon, banks became so fearful to lend to one another because they were afraid that they would receive bad mortgage-backed securities, and they weren't sure how much bad debt they had on their own books. And so this obviously created a ton of volatility, and if they were to lend to each other and they were to receive bad mortgages, then their credit rating would be lowered, and then stock prices would fall. And so they would go out of business. And of course, we ultimately know what did happen. Stock prices did fall. Many companies did go out of business, and countless people lost their homes. Times were indeed rough. And it's important to understand just what the differences were now and what it's like today. Even though we never know what's going to happen in the economy, there were vast differences in what was going on leading up to 2008 and how the market is today. Now, if you have any questions, fire away. I invite you to connect. Please ask. And the next video is going to be how to protect yourself if there is a dip in the market.